Welcome everybody to this Derivatives Masterclass. We're so excited to have you here. AIB, Access Africa and Abojani Investments have collaborated to bring you this webinar where you have the opportunity to learn from the best about this particular investment option. And we are so excited to have you here this evening. I'll introduce both the companies and today's panelists, and then we'll dive in. AIB Access Africa is the fusion of two established companies, AIB Capital and Apex Africa Capital, both with over 25 years of experience in the securities market. AIB Access forms part of Access Group, which is based in Mauritius with subsidiaries in Switzerland, UAE, and Hong Kong. AIB Access Africa's key services include stockbroking, bond trading, and we recently had an amazing bonds masterclass, and derivatives and SLB, which we'll be hearing about today. AIB also provides online stock trading capabilities through the established brand AIB DigiTrader, which is both an online platform and a mobile app, the first fully automated trading platform in Kenya. Clients can open CDS accounts and trade and make payments remotely. We now have the same capability with derivatives trading, which you'll be hearing about today, where clients can open accounts and trade online. All right. Abojani is a financial literacy organization. Financial literacy is the understanding of personal and corporate finance matters such as investing, saving, budgeting, compound interest, the stock market, and portfolio diversification. Abojani Investment helps professionals and entrepreneurs get the right financial education and build fully diversified investment portfolios to help them accomplish their life goals. In today's webinar, you'll have the opportunity to listen to an industry leader within the derivatives trading space, who I have the honor of introducing today, Brian Tanui. Brian works alongside Titus Marenye, who we had the pleasure of hosting in a recent bonds masterclass. Brian joined AIB Access in June of 2017. Previously, he was a financial markets analyst at Futures First Kenya, where he traded soy complex futures on Chicago Mercantile Exchange. He's presently pursuing the CFA charter, where he's a level 3 candidate. So happy to have you with us today, Brian. Welcome. All right, so with that brief introduction, let's dive in. Brian, I'll hand over to you.
Good evening, everyone. As you've heard, my name is Brian Tanui, and it's an honor and a privilege to have you here. And hopefully by the end of this webinar, we'll have managed to demystify what derivatives are and how they can help us meet our financial objectives. So a quick introduction to derivatives. So what are derivatives? Simply, a derivative is a financial instrument whose characteristics and value depend on an underlying asset. That asset can be an equity security, it can be currencies, bonds, interest rates, or even commodities. So there are two main types of derivatives. So there are forwards and futures. So for forwards, a forward is an agreement to exchange an underlying asset at a pre-agreed price at a future date. And for futures, it's pretty much the same thing, but the key difference is that futures trade on exchanges. So by virtue of trading on exchanges, they're a lot more standardized, and there's no counterparty risk with them. I will demonstrate this further as we move along. Yeah, so as an illustration, suppose we have Janet, an investor at the NSE through AIB Access, and she's looking to purchase 5,000 shares of Safaricom on March 2022. Similarly, we have Peter, another investor at the NSE, but Peter is not our client. Let's say he's investing through XXX Capital. And Peter already owns 10,000 shares. So Janet and Peter can enter into an agreement to transact the 5,000 shares at a price of say 42 shillings on the given date. So there are two ways the two parties can transact. Janet and Peter can meet and interact. This is an over-the-counter transaction whereby Janet gives Peter the cash. So it would be 42,000 times the 5,000 shares. And in exchange, Peter would transfer the shares to Janet. So this is an example of how forwards work. So they've agreed to exchange the Safaricom shares at a future date, 31st of March, 2022, and the price is set today. A second way Janet and Peter may choose to transact is through the NSE. So in this scenario, when Janet places an order to buy on the exchange would match the order with Peter's sell order. So the cash would transfer from Janet to Peter, Janet to the NSE and from the NSE to Peter, and the shares vice versa. So as you can see, in this case, Janet and Peter do not have to ever meet. And so NSE stands in the middle of the transaction, and this guarantees the performance of the contract while also eliminating counterparty risk. So NSE will make sure that the shares are transferred and the cash transfers. In the earlier example, it's clear to see that by 31st of March, Peter may have already sold the shares. Janet may not have the cash, so the contract may not go through. So that's called counterparty risk. So that's the key difference between futures and forwards. Next slide, please. Yeah, so coming to our local setting, the NSE launched the Nairobi Derivatives Exchange, which is called NEXT, in June 2018. And the securities offered on NEXT are index futures and single stock futures. So they're hoping to increase the offerings to maybe include commodity futures and maybe some fixed income products. So, but for now, what we do have is single stock futures and index futures. And since then, AIB Axis has managed to command a market share of about 40% of the emerging market. So far this year, the market has really grown. It's continuing to grow. And so far, we've transacted, the market as a whole has transacted about 750 million derivatives, worth of derivatives. So yeah, NEXT enables you to trade, as I said before, index futures. So there are two types of index futures. So there's the NSE 25 index futures, and there's the mini NSE 25 index futures. And I will demonstrate the difference between the two at a later stage in this presentation. And also there's single stock futures offered. Yeah, so for now, the NSE and the market determined that we need to limit the eligible securities because of liquidity considerations and how big the companies are as a starter for safety reasons. So right now there are 6 single stock futures available. So there is Safaricom, KCB, Equity, EABL, BAT, and ABSA. And for the index futures, there's the NSE 25 and the mini NSE 25, as I mentioned previously, which begs the question, what is an index? So an index is simply a basket of shares. So for NSE 25, its composition is basically the biggest 25 companies currently listed on the NSE. So it is equivalent of buying 1 share of Safaricom plus 1 share of KCB plus 1 share of Equity plus 1 share of DTK and the biggest 25 companies. So right now, the summation of those prices is about 4,000 Kenya shillings. So that's how the NSE 25 is made up. For the mini index, how the futures are listed the NSE 25 share futures, it's equivalent of buying 100 shares of each counter. So that would give you a value of about 400,000. So which would give you a value of about 400,000. And for the mini index, it's equivalent of buying 10 shares of every counter, giving you a value of about 40,000. I'm open to fielding questions on the same at this stage. On the index.
Someone is asking if index futures are bought in batches of 100. Maybe you can just repeat that.
So that's what I was saying. So for the index, it's similar to one share of each counter, but it trades in bundles of 100. So it's equivalent of 100 Safaricom plus 100 KCB. That would give you the value of 400,000. And for the mini index, it's bundles of 10. So that would give you a total value of about 40,000.
Okay, great. Can go on.
Okay, so with respect to the actual as the broker, AIB Axis retains the right to close positions which are in breach of margin and capital adequacy requirements. And secondly, there's a broker execution. In this case, the client sends orders to the broker for the broker to execute. The broker may advise the client, but at the end of the day, the decision rests to the client. Right, so this is how the next market looks. It trades on a platform called Ovento, and this is what direct market access clients would be able to see if they were to log in. Looking at the image on the left, that shows the single stock futures and how they're quoted on the exchange. So at the top, there's a 16 to sub-21 EQTY. So this is a contract, derivatives futures contract expiring on 16th September 2021, and the underlying securities equity shares. So that was today actually. So today was expiry. So this contract has expired. We have 4 expiries over the next 1 year. So having expired today, the September 2021 equity contract, tomorrow the NSE will quote us September 2022. So you can buy futures for September 2022 as of tomorrow. So for the highlighted one, 16th June 22 equity, that's a contract expiring on 16th June 2022, and the underlying is equity. So looking on the image on the right, the highlighted contract, it is 16 DEC 21 and 25I. So that is the index futures that expires on 16th December 2021 for the NSE 25 index. And at the top there, 16 September 21, 25 MN, it means the mini index. Looking at the market, you can see there's a column of Bs and a column of Ss. So if you want to buy, you would click on the B, and then you'd be able to input your details and also the volume that you want to transact. So if you want to get into 2 contracts, you'd place 2, and then yeah, that's it. So this is what the futures market looks like at the moment.
Quickly, there's a question on this. What is the minimum amount of shares I can buy on the index shares?
On the index? There's really no minimum. It depends on your pocket. So we'll come to how how the actual trading works, and there'll be a small illustration on the same. So the market works on margin. So as long as you can pay the margin, there's no minimum.
Okay, great. Someone is asking how they can access live or the trading, but I think we'll touch on that later.
Mm-hmm.
Okay, that's
Yeah. So the market structure. How is our market structured? Again, I'll use the early example of Janet and Peter, and just to anchor the example. So looking at it, we have the NSE derivatives market next. So that is the exchange. We also have clearing members. Naturally, because these are financial transactions, banks act as clearing members to facilitate the settlement. So if someone has made a gain or someone has made a loss, then the banks are there to facilitate that. And so working with the left side, for example, Janet was an investor through AIB Axis, and Abojani also is also a client of AIB Axis. So you can see the structure. You have Janet and Abojani, who are clients of AIB Axis, and AIB Axis works with the bank to facilitate settlement. And so Janet's order would pass through AIB Axis to the exchange. And on the far right, you have Peter, who was a client of XXX Capital. And for his case, his orders would be routed either through broker execution or direct market access. It would be routed to the next market. And they may have a different clearing member versus ourselves. So for us, our bank account for derivatives sits at Coop Bank. So market fees, this is the key benefit of using derivatives. So as you can see, for single stock futures, the total fee, all-in price, that includes NSE, the broker fees, investor protection fund, comes down to 0.17%. And for the index futures, it's 0.14%. So for those who have participated in our market, you know that the fees are a bit high. So buying shares on the NSE, the all-in price is usually about 2%, 2.1%. So this is a massive difference, about 10 times lower than the fees on the normal exchange, normal shares. So to further understand derivatives and how they operate, it's important to try to understand leverage and margin. So what's leverage? Leverage is the use of borrowed money to invest. And I will demonstrate this with a worked example. In next, this means not having to put up a full amount of capital to transact. So, but the capital that you do need to put up, this is referred to as margin. And it will become clear in the next slides how the two interact. So for the next market, one contract is usually equivalent to 1,000 shares. And again, this will be demonstrated in the next slide. So for the margin, we have 4 different types of margin. So we have house margin. This is collected and held by the broker. The amount collected is 10% of the total funds deposited. For the initial margin, this is a good faith deposit required to open the position. And you can think of the initial margin as the price of the contract. And these funds are held by the bank, and they're refunded once the position is closed. For additional margin, this is collected and held by the bank on top of the initial margin. Again, we'll be able to demonstrate in a worked example. And it's also refunded once a position is closed. Variation margin, lastly, this is the amount that is due to a client or from a client as a result of daily price movement. So in a market, the prices usually change and generating profit or loss. And this is what is called the variation margin. We can proceed to the example, and then we can go back to that slide just to ground it. Yeah. So again, let us go back to our client, Janet, who wanted to buy Safaricom shares, 5,000 in March 2022. So she has an option of entering the forward with Peter, or alternatively, she may decide to come through the next market and do that at a fraction of the cost. So suppose on 1st of October, she walks into AIB Access she deposits the 50,000 shillings at Coop Bank. So we'll see how the transactions that will occur and till the day maybe she decides to withdraw her cash. So she walks in with 50,000 Kenya, she deposits 50,000 Kenya shillings at Coop Bank. So for ourselves, we would retain 10% as house margin. That would leave a balance of 45,000 eligible for trading. She also wanted to buy 5 contracts for 17th March 2022, Safaricom. So the initial margin for Safaricom shares for that particular contract is 5,000 shillings. So that would cost her 5 times 5,000, that would be 25,000. Additionally, the bank would retain additional margin at 10% of the initial margin. So you can see there it's 2,500, which is 10% of the 25,000. So a clear difference is that additional margin is computed on the initial margin rather than the total amount that she walked into the farm with. So her transaction cost would be 357 shillings, which is given by 5 times 1,000. So 5 contracts times 1,000 shares per contract at the price of 42 shillings. And so the rate is 0.17. So as you can see, it's a lot lower than the other scenario. So after the transactions on 1st of October 2021, her balance, her available balance would be 17,143 shillings. So let's move to December 31st this year, 2021. Supposing the price stays flat till December 31st, then there's a shift to 40, it's going for 40 shillings. So how will this affect her? Because she was buying, this will count as a loss. So she will have lost 10,000 shillings given by, it's a drop of 2 shillings times the 5 contracts times the 1,000 contracts per share. So her balance at this point would be 7,143. Going to the expiry, upon expiry, let's say the price has managed to rebound and the price is now at 43 shillings. So the variation margin, she would have made a gain of 15,000 from the previous repricing at 40. So 43 minus 40, that would give you the 3 shillings. So she would have made 3 shillings times the 5 contracts times the 1,000 shares per contract. So she would have made 15,000. As you can see, the net effect is a gain of 5,000 on the variation margin. So upon expiry, the contracts would close. So her initial margin would be refunded and her additional margin would also be refunded. So giving her a total balance of 49,643 shillings. Now, on the next day, having closed out her contract, she may opt to withdraw and leave the market. So in that case, we would reimburse her the house margin, bringing her total, the total amount of money in her account to 54,643. So the total gain would be 4,643 shillings. Any question?
Okay, I think at this point we'll take some questions. So someone is asking, is there a minimum margin level?
Yeah, so today is expiry, right? So tomorrow morning, the NSE would send out a list of the initial margins for the different securities. So right now, in our worked example, March 2022, it would be 5K for Safaricom. Tomorrow, they may change it. So the NSE does the calculation for the initial margin for all securities, and it's based on things like volatility and so for account and the underlying price. So for it's usually about 10 to 12, 8 to 12% of the price of the underlying security. So, for example, for 1,000 shares of Safaricom right now at 42, it would cost you 42,000. So, instead of putting up the 42,000, you put up the 5,000. So, which is about just above 10%, closer to 12%. Yes.
Okay, and someone is asking, in this transaction example, what would happen had the share price remained at 40?
Yeah, so in our example, if the share price remains at 40, the key difference is the variation margin given by the 15,000, the 3 shillings. It would not be there, right? So rather than having a balance of 54,000 at the end, it would be less 15,000, which would give her a balance of 39,643. So she would have a loss of that amount. So she would lose the 10,000 plus the charges.
Okay, and someone is asking, can one withdraw before contract expiry?
Yes. So derivatives market, it trades intraday. So all these transactions here could happen between market open and lunchtime. So you can enter a position at 9, exit it at 10, enter another position at 10:30, exit at 10:32. It trades intraday. So that's a key difference between this market and the normal market.
Okay, let's say your expiry is on 31st of December or whenever, and between that time you realize you're likely to lose. Can you amend the expiry date?
No. So there are only 4 expiries per security, as demonstrated previously in the image of what people will see in the market. So you would see, so starting tomorrow, you would see the nearest contract being December, then March, then June, then September. So, and they always expire on the 3rd Thursday of the month, of the quarterly months. So as you can see, the dates are usually about 16th thereabouts. So for September 2022, I think it will be 15th of September 2022. That will be the 3rd Thursday.
Okay, those are the questions I had. Okay, we can go to the previous slide or to the next.
I think this would be dependent on the questions. And
maybe we can just touch on the previous slide and then move on.
Yeah. So having gone through that example, we can now ground the theory to what we've just witnessed. So the house margin, as you could see, was the 5,000 we collected on the first day, and it was 10% of the total of the 50,000 that was deposited. The initial margin, this was the price of the Safaricom contract for March 2022, which was 5,000, and we could see that. For the additional margin, this is the 2,500 that the bank held back to act as a buffer for themselves. And the variation margin, that would be just the P&L, normal P&L. And so leverage, how leverage works, because instead of putting up 42,000, you're just putting up 5,000. It's essentially as if the NSC has loaned you the other 37,000. So the purpose of house margin is a buffer for ourselves. So at every stage, because this is a leverage product, at every stage, it's important to manage the risks. So given our example and say the price at 40, you can see that the balance is 7,643, right? So what would have happened, say, if it had gone down another 2 shillings? That would have made another loss of another 10,000. That would be a deficit. There would be a deficit of 3,000, about 3,000 shillings. So how would we recover that? So we would be forced to call you to request you top up your account, and maybe you may not be liquid at that point in time. So that's where we retain the recourse for closing the position. Also, the house margin we've retained would serve as a protection fund for ourselves. So we could draw into the cash, the 5,000 we retained, and make sure the market settles. As I said, this market settles at T+1 the next day. So there's really no time to be chasing guys to come and fund, and there are penalties for if market does not settle in good time. So that is the reason for all these margins. So house margin, it's for ourselves, to protect ourselves. Initial margin, it's just for the market structure. For next, additional margin is for the bank. So if the amount in house margin is not sufficient, then the additional margin would come into play. And then if that's not sufficient, then initial margin would come into play as well. So that's the theory. That is why the margins exist.
Okay, quick one. Someone is asking, sorry, 1 second. Why is there a house margin? I think we've answered that. All right, I think we can move on to the next slide.
Mm-hmm. So account opening and funding. So the next market is different from the spot market. So the normal CDSC account does not work here, because the NSC, the next market, it's an NSC market, so it has nothing to do with CDSC. So you need to open a new account. So it's the normal process. You fill out a form and you provide the requisite KYC, and then our front office and compliance team will process the application and open the account. So it's a simple process, opening your account. We are presently operationalizing auto account opening on derivatives. So for those of you who are familiar with the products, we currently offer on DigiTrader, we have a product called DigiTrader, whereby you can open your normal shares account, and from the moment you and trade on your own without having to interact with a human party. So we're working on doing that for derivatives, and soon we should be able to roll out the same. So this is so the maximum amount for DigiTrader is actually 3 million, not 1 million. Yeah, so you can open your account remotely and trade remotely rather than filling the form. Funding, as mentioned, our bank is the Cooperative Bank of Kenya. Yeah, so you just deposit the funds there, and it should reflect in your account and in your statement.
Before we move on to SLB, maybe we can field any questions on derivatives. So I'm going to open the Q&A and ask some questions. Someone is asking if it's possible to do a live demonstration. After this masterclass, we are planning to do a live demonstration. You'll be able to sign up. We'll be sending a link to all participants. The next question was, I can see the current index fund price is 4,000. That's for the NSE 25. Does it mean that I can buy the index with only 4,000 shillings?
With respect to the index, similar to what you've just witnessed, you can go back to the worked example, Naila, please. Yeah, so for the index, the initial margin is usually about 42,000. It's a bit higher than the 4,000. So they trade in bundles of 100, right? So for the notional of for the 400,000, you'd be required to put up about 42,000. So it's more expensive to trade an index. So that is why we in discussion with the NSE, we thought it would be best to launch the mini index. So for the 40,000 mini index, your initial margin would be about 5,000, making it cheaper, and you get the same exposure. So you can now trade in easier. It's easier trading in bundles of 40,000 rather than trading in 400,000. So the margin is different. Each security, the margin is different. For something like ABSA, which the underlying share is about 10 shillings, or yeah, I think it would cost you, the initial margin is about 1,500, 1,900 thereabouts. So it would be cheaper to buy ABSA contracts versus buying an index. I think that is just natural. Even right now, if you want to buy Safaricom shares versus buying EABL shares would be more expensive.
Okay, and someone is asking, can the broker follow the market for you and make decisions instead of the client following the market?
So for discretion, that's discretionary accounts. Presently, we mostly, for the most part, it's client controlled. So I can advise, or traders can advise, but at the end of the day, the client has to make decisions on their portfolio, and it becomes a bit dicey if I make decisions on your behalf. I can guide, but the client retains the overall authority of his account.
Okay, and James is asking, from your experience, how has the derivatives market performed in terms of returns?
So that's usually a very tricky question. People ask that a lot. If you look at the NSE, the normal market, you can say it's been on an uptrend recently. You can, for some, they would say they haven't made money, but that's based on individual decisions. So the people who've managed to make some money, and there are some people who've made losses based on decisions. So, for example, looking at the overall market since 2020 January, say you are in both markets, and you are long. If you sold in June last year and stayed out of the market, you'd have had losses of upwards of 20%, right? But if you bought last year June, you're looking at profits of close to 50%. For example, equity was trading at 30 shillings, and this year it traded at 54 shillings. So that's a gain of 24 over 30, which is about 80% profit. So it's very personal. There's money to be made. As you can see, you don't need a lot of money to make a big profit. In this example, say on contract expiry, if the price was at 45, should have made another 10,000, which would make a profit of 14,000 of out of putting up money 50K. So that's good profit.
Okay, and I think before we move on to SLB, someone is asking, why should I invest in derivatives instead of just sticking to the equity market? I think they're asking for the benefits.
Yeah, we can go to that.
Okay.
So the benefits are leverage. So for the client, Janet, in our previous example, she was able to get a position equivalent to 5,000 Safaricom shares using 50K. If all her money, all she had was 50,000 shillings, the maximum, all she could have bought is 1,000 shares. So a profit, if the market had gained 3 shillings, should have gained only 3 shillings. But in this case, if the market had gone in her favor with 3 shillings, should have gained 15 shillings. So you can accumulate profits faster on this on derivatives versus the other market. Another key benefit is the costs. So as you could see, it's 17 bips versus 2.1% for the single stock, and 0.14% versus again 2.1% for the index. Another key benefit is a reduction of execution time and intraday trading. So as I mentioned earlier, you can trade multiple times throughout the day. So you can enter a position at 9:01 and exit at 9:05, enter another position at 9:30, exit at 9:30 and 30 seconds. So you can trade multiple times through the day. So you have increased flexibility. If you get negative news, you're not locked in until settlement T+3. So there's that reduction of execution time. Another benefit, so there's no counterparty risk. So this is not a benefit vis-a-vis the normal market. This is a benefit versus the forwards. So rather than Janet and Peter interacting and facing counterparty risk, the NSE would be there, and they would be able to guarantee that both parties get what they are after. And so the last point, additional income, I think that relates to SLB, which we haven't discussed.
Okay, and the final question before we move on to SLB, remember there'll be a quick Q&A at the end. Is the transaction cost of 0.17% charged on both buying and selling?
Yeah.
Okay, great.
It's the same as the normal market.
All right. Mm-hmm. So I think we'll now quickly touch on SLB, and then we'll move on to the Q&A.
Mm-hmm. So SLB is an acronym for Securities Lending and Borrowing, which is the temporary transfer of securities from one party to another. So in our example earlier, Peter would be the lender since he holds the shares in his account, and maybe a different party would be a borrower. So, it's the temporary transfer of securities from one party to another with a simultaneous agreement to return the securities either on demand or at a future date. So the lender usually has recourse to request the securities back, but typically it goes till expiry of the contract. So this is a product by the CDSE, and we are registered as a securities lending agent in September 2022. So if you currently have shares in your CDSE account, you can lend them and maybe make a bit of money on that. So the eligible securities for SLB are the constituents of the NSE 20, and they decided to constrain the eligible securities because of liquidity and market capitalization considerations. So you don't want to lend out shares which the counterparty would have a hard time getting it back. So yeah, we can go to the next slide. So what are the market features for the SLB market? So eligibility. So all accounts which hold shares are eligible to lend. However, for a borrower, you must first have approval from an SLA, as well as having adequate collateral for whatever you want to borrow. So this is intuitive in the sense that the party who's borrowing will have to buy back the shares. So if the party in our normal interactions, there are some clients who take a long time to pay up and such things. So we may not be very willing to have them participate as borrowers because they would expose us to a lot of risk. But as long as you have the NSE 20 account shares in your account, you can lend. Presently, the lending rate is about 7.5%. So that's an additional income you could receive. So with respect to collateral, acceptable collateral are cash, government bonds, and bank guarantee only. So things like logbooks and title deeds are not eligible for to be used as collateral. This is because of liquidity management. So if you need to get back the cash to buy shares back, you can't be going around trying to sell your land or sell your car to raise funds. So that's why it's only cash, government bonds, and bank guarantee. And the collateral, it sits at the client settlement account, and it earns a call rate. So call rates in Kenya are about 5-6%. So it would earn that, and that accrues to the borrower. So matching. So the borrower would submit a borrowing request, and the lender would submit a lending request on the platform, which is Perago. So they would specify the security they want to lend, the lending rate, and also the duration. So if all those parameters are in line, then the request would match, and the shares would transfer from the lender's account to the borrower's account, and the collateral will be locked simultaneously and instantaneously. So if the transaction, say they match at 11, they would move immediately at 11, and the shares would be available for the shares would be available to the borrower. So settlement occurs on the day after expiry. So for example, today, using our example, today is expiry day. Tomorrow, the money eligible for the lender would be in his account, plus the shares would also be there. And again, the CDSE would act as the intermediary in between. So that eliminates counterparty risk. So you'll always get your shares back and also get your lending rate if as the lender. Yeah, so those are the features for the SLB market. Yeah, so quickly on risks. So there's market risk. This is present in even the normal market. So you can buy shares and they go down, sell shares and they go up. So that's market risk. There's really not much you can do about that. There's margin call. As mentioned, the derivatives trade on margin. So you'd be required to top up. So if it's an inopportune moment and you can't top up, your positions may be closed and you may not want that. So that is a risk. Another risk is liquidity. This is there in all markets. So you may want to sell or you want to buy, but there are no buyers or there are no sellers, or they're not sufficient at the price you want to trade. So this is about how easy is it to transact. So that's a risk in all markets. And another risk is the availability of the SLB shares. So as a borrower, you may want to borrow, say, a counter like NMG for our scan group, and maybe there are no lenders on the same, or what you want to borrow is not part of the NSE 20 index, so it would not be eligible. So those are some of the risks that we face in both derivatives and SLB.
All right, shall we move on to the Q&A? All right, so we have quite a few questions, both from derivatives and SLB. Someone is asking, one second, sorry. Is lending done in multiples or any amount is acceptable?
Any amount is acceptable. So if say you hold 10,000 shares like Peter did, and you can opt to lend maybe just 1,000, you can opt to lend to make them available for lending. You can make lend 5,000, 7,000, and for the lender you have an option of, and also for the borrower, you have the option to say it can't be partially traded. So if you want to lend 5,000 and someone wants to borrow 3,000, they would not match. But if you've left it open, it would match, and then you'd have the balance of the 2,000 in your account.
Okay, and by lending my shares, will it affect me getting my dividends?
No, so securities lending and borrowing has been there in the financial markets globally for a long, long time. And the rules are structured to protect the lender primarily. So the lender is eligible to all all benefits of owning the shares. It's incumbent on the borrower to pass through any corporate actions that accrue to those shares. So if there's a dividend, then the borrower would have to pass through the dividend. If there's a share split, same case, or merger, same, or buybacks, same case. Okay. I don't think buybacks, just for the splits. So for splits and dividends, the lender, it accrues to the lender. And CDSC guarantees that this happens.
Okay, and someone is asking what would motivate someone to borrow shares instead of buying them?
The same thing that motivates people to sell shares. So you may have a negative view of the market, and or you may think a counter is overvalued. You can borrow and go short. So you borrow, for example, Safaricom at 44, maybe you thought it's expensive. You can borrow from Peter, the 10,000 shares, you sell at 44, you receive the 440,000 shillings. Price drops to 42, you buy back the 10,000 shares, you pay 420,000, and you return the shares to Peter, you have your profit of 20,000 minus, of course, the fees.
Okay, and this is for the derivatives market. In case there are no buyers and I want to sell my contracts, does that mean I'm stuck in the market?
Yes, same as if you own shares in, say, when NMG was falling, there were no buyers, so you're a bit stuck. But liquidity is improving, and ideally, we should be able to give you a quote on the same. So you should not get stuck, unless there's an extreme market event. You should not get stuck.
All right, and are there, how does one become a lender or a borrower? How does one join SLB or start?
Yeah, so you just have to fill a form. If you already have the CDC account, it's just now an SLB agreement between ourselves and yourself, and then you can start.
All right, so they'd have to reach out to fill a form.
Yeah, so for this case, there's no auto opening. You have to fill a form to govern that relationship.
Okay, and I think I'll take two more questions because of time. One question is, at the time of lending and there are dividends announced, does the lender get the dividends immediately, or do they have to wait until the contract expires?
Yeah, so it's on T+1 of settlement. So they would get it after the contract expires. So for someone with you need to manage your risk, right? If you need the dividends, it can work both ways. You can get your dividends faster or slower. An example is you've lent out your shares to be returned end of September, and the dividend payment is in October. So in this case, you'd get your money faster versus that. And if on the flip side, expiry is further than dividend payment date, you would have to wait for the dividend. So it can work both ways, and you can be savvy with how you want to structure, how long you want to lend your shares for.
All right, and Peter is asking, are there other fees involved apart from the rate?
So mainly it's that. But as a borrower, once you've borrowed, you'd still have to transact on the normal market, right? And then you'd have to pay that transaction cost, the 2%.
Okay, I think that's it for now. We can't take all the questions, but if you have any further questions, please submit them to the info@abaccessafrica.com, and we'll try to answer those during the week. However, we'll also have just a reminder that we'll have a live demo session as a part 2 to this presentation. It will be a demo, and we'll also have a further Q&A just to guide you practically in trading derivatives, and we'll probably also include SLB. So once you leave the Zoom, you'll get a questionnaire. Just fill it in if you want to be part of that demo. It will also be emailed to you automatically, so just fill that in if you want to be part of the demo. All right, so I think that's it for today. I hope it was a good session. I can see in the chat, people are saying it was informative. Thank you so much. Thank you so much, Brian. I think we'll close there.